Now, regarding the topic at hand, let's talk about the current state of the overall Chinese economy. Different media outlets may describe the situation in various ways, but the consensus is that China is currently in a deflationary phase. This is a point on which most agree. Take a look at this. Some articles even mention that China has entered a deflationary spiral, while others describe it as worsening deflation concerns, which is a more vague expression. But either way, it's clear that China is facing deflation. This shouldn't be surprising to anyone who has been following the situation. One major reason for this is the collapse of the real estate bubble. Property prices have skyrocketed to ridiculous levels and are now deflating. This, of course, points to deflation. Just looking at the drop in real estate prices, it's clear that we're dealing with a deflationary trend. As real estate prices fall, the costs associated with building properties, like materials and transportation, will also decrease, especially when demand is no longer as high. In this situation, sellers of these materials and transportation providers will have to lower prices to encourage buyers. This is essentially a case of oversupply, which we've seen not just in the real estate sector, but across various industries, particularly those targeting the affluent or middle-class consumers. For example, high-end restaurants are closing down as they no longer have customers. Businesses selling luxury items like birds' nests and wine, which wealthy people tend to buy, are also struggling. Even the auto industry is suffering due to intense price competition. At its root, this is a problem of excessive competition. When a business becomes profitable, many new players rush in, leading to cutthroat price wars. This excessive competition results in companies lowering their prices to capture market share. But cutting prices also cuts into profits, and even small changes in production costs can bring a business to the brink of bankruptcy. When times are good, the economy is described in glowing terms, but when conditions change, doubts begin to surface about whether those past developments were truly beneficial. When I was in China, one thing I often heard was that Japanese companies make decisions too slowly. When Chinese companies and Japanese companies would start new ventures, the decision-making process on the Japanese side would often take half a year, or sometimes even a year. This slow pace led to missed business opportunities, and the perception that Japan was falling behind. In China, as soon as something is seen as profitable, people jump in quickly. When I was in Shanghai, for example, there weren't many bubble tea shops at first, but once one chain became popular, there were soon long lines. Bubble tea shops then spread rapidly. The same thing happens in Japan to a certain extent, with trends like bubble tea and warabi mochi shops, but in China, this happens in almost every sector. People rush into profitable businesses, which leads to intense competition and price wars, and eventually, many companies fail. This pattern is becoming increasingly common across different industries in China. While it may seem that quick decision-making and early entry into a business leads to profits, as more competitors enter the market, it becomes harder to make money. This makes it difficult for businesses to sustain long-term success in China's fast-paced market environment. On the other hand, Japanese companies tend to thoroughly assess the risks before entering a new market. They take their time, evaluating every possible outcome, and this cautious approach, while sometimes criticized for being slow, may not be entirely bad. This methodical approach to decision-making ensures that Japanese businesses remain focused on their core strengths. For example, you wouldn't see a company like Suntory suddenly decide to start manufacturing cars just because they're successful in the beverage industry, but that kind of diversification is not uncommon in China. For instance, companies like Evergrande were building real estate but then decided to start making cars. This type of diversification can make the economy fragile. In contrast, Japan's focus on refining and mastering core businesses might be its hidden strength, even if Japanese people themselves are often unaware of it. But that's not the main point of this discussion. The key issue here is that the overall Chinese economy is experiencing deflation. The real estate bubble has burst, property prices are falling, and even the prices of cars are dropping due to fierce competition. Recently, even BMW has slashed prices, with some electric vehicles being sold at nearly half their previous price. Some luxury models have seen price cuts of over 10 million yen. It's a brutal price war. Yet, despite the deflation, food prices are rising. Let me show you this article. It discusses why vegetable prices are going up in China. For example, the price of green peppers has risen by 45.62% compared to the same period last year. So, while the economy is slowing down and deflation is widespread, the price of food is rising, creating a dire situation for the average person. Salaries are being cut, bonuses are shrinking, and in some cases, People aren't even getting paid. This is happening even to government employees in some regions. One reason for rising food prices is the severe flooding that occurred earlier this year, which was expected to impact agriculture. As a result, the cost of vegetables has soared. But it's not just the weather. Another factor is the weakening of the Chinese yuan against the US dollar. This has increased the cost of imported goods like fertilizers and energy, which are critical for farming, transportation, and storage. This, in turn, has driven up the price of domestic agricultural products. Now, let's take a look at pork prices, which are a major concern in China. Pork prices have also been rising steadily. According to a chart from last December to this August, pork prices have increased. Another chart shows the ratio of pork prices to the cost of pig feed. The feed in question is primarily corn, which is used to raise the pigs. Chinese authorities monitor the ratio between the cost of feed and the price of pork at the time of shipment. Generally, when the ratio reaches 6, it means the pork producers are neither making nor losing money. As the ratio climbs higher, pork prices increase, and producers see larger profits. However, if the ratio exceeds 9.5, the government issues a red alert warning about excessive pork prices. But while pork prices may be rising, it's not necessarily true that producers are making more profit. That's because other production costs, like electricity or the price of breeding pigs, may have increased as well. So the rising price of pork could actually reflect an increase in these other costs. To summarize, while China's economy is experiencing deflation overall, certain costs, such as food and electricity, are rising, which puts additional pressure on everyday Chinese citizens.